G'day, Scuddy here. Quick video looking at the yen. And after a near big figure rally off the lows, it's pretty clear to me that the easy gains have now been won and run. And when I look at upcoming event risk, when I look at where dollar yen sits on the charts, when I look at the recalibration of Fed rate cut expectations over the next year and a bit, rather than being bullish, to me, directional risk now, despite what the charts are telling me here and now, are potentially skewing to the downside. As a reminder, dollar yen remains really heavily influenced by the US interest rate outlook. And you can really see that here in the rolling 10-day correlation analysis with a variety of different financial market metrics. From top to bottom, we have end 2024 Fed rate cut pricing, end 2025 Fed rate cut pricing, US 2-year yields, US 5-year yields, US 10-year yields, and then Japanese 2-year yields down the bottom. And you can see here the score with that is 0.46 over the past fortnight. So not a meaningful or really strong relationship one way or the other. Compare that to what we're seeing when it comes to movements in US interest rates. US 10-year yields, US 5-year yields, 0.92. So almost moving in lockstep with one another. And the shorter you go down the curve towards the front end, you can see here it's still pretty strong, 0.87, 0.85, 0.89 and the like. So it's pretty clear that the US interest rate outlook remains the key determinant of directional movements when it comes to dollar yen. And one thing we've seen recently is that there's been a pretty decent recalibration in expectations about what the Fed is likely to go and do over the next year and a bit. So this chart on your screen is looking at the Fed funds curve out to the end of next year, so the December 2025 contract. And you can see here in the middle of September, we had markets pricing in 225 basis points worth of cuts. So that equates to 9 25-pointers. Now you can see here as a consequence of some recent strength coming through in US labor market data, and of course more recently that hot CPI report that we received last week. At one point last week, markets actually had gone and stripped back, pared back those expectations for rate cuts by the end of next year to less than 6. Now it's gone a little bit, reverse that now, a little bit over 6 being priced here and now, but we're still seeing a pretty big recalibration in expectations. And that's flowing through to what's going on when it comes to yield spreads between the United States and Japan. So you can see here in this left-hand pane, in gray is the 2-year spread between the US and Japan, 10-year spread in red, and the 30-year spread in blue. And you see that what we've had is a pretty decent uplift. So we're seeing that spreads have gone and widened again in favor of the United States. And then lo and behold, that's gone and flowed through to a pretty chunky rebound in dollar yen. But when I look at this now, and I look at where they are, so particularly for a 2-year spread, so here and now, when you look at where the dollar yen was sitting in the charts when it was last around this level, it was below where it was, around about 147 or so. And that's the same again when you look at what's going on with the 10-year spread as well. So you could argue at this point in time that relative to where spreads sit near term, that maybe dollar yen is looking a little bit rich already at this particular occasion. Now, the question I start asking myself is, okay, after we've seen this hawkish recalibration and the markets have pared back those expectations for the scale of rate cuts from the Fed, what's the next thing that's going to go and spark a potential move back towards the levels we saw earlier this year, where we saw real blowout in spreads and of course dollar yen trading north of 160 at one point. And it's not to say that it's not possible in the near term. Certainly the trajectory of some of the data that we've seen recently suggests that it's possible, but near term, I look at what's coming up on the economic calendar in the States, and I just can't see anything that's really going to go and meaningfully move the dial, at least into the latter parts of the week. So if you look through, it's a very busy calendar. We've got lots of Fed speakers. You can see Kashkari, Waller, Kashkari again. We also get data out of Japan, but there's not a lot to go and hang your hat on. I don't think it's really going to go meaningfully move the dial unless we see potentially from the Fed members a concerted effort to go and manipulate current market expectations, which is a little bit less than being fully priced for a 25-pointer to come through in early November. To me, the real kicker, the real event risk towards this week is at the back end of the week, and that comes in the form of a couple of different releases. So the first is the retail sales report. You can see here 0.3 is expected for the headline. To me, it's going to be the core retail sales, so ex autos, and the control group retail sale figures to go and keep a close eye on. And to me, it's pretty important that it impresses, because when you look at the other big release on that day, initial jobless claims. So you can see here, a 258,000 increase. That was the highest level in around about 2 years in the week prior. And that was because of hurricane disruptions. And of course, Hurricane Milton wreaked havoc across the Gulf states, particularly Florida, late last week. And that just happens to be the week where the initial jobless claims report is going to be impacted. Yet markets are looking for a curtailment. They're looking for 241,000. Given what we saw with that particular report, to me, the upside risk to that particular area. And even though it's likely to be reflective of short-term factors and temporary factors, we know markets have been hypersensitive to any changes in labour market dynamics in the United States. So if anything is weak coming through, it's hard to go and say, well, that's going to go and push yields higher. Indeed, you'd imagine that it'll probably go and retrace like we saw on Thursday, where that hot CPI report last week was kind of offset by that jobless claims figure. So to me, that's the key number to go and look at, and the retail sales report, because it needs to go and show some strength to go, in my book. We do see that upside risk coming through in claims to go and offset that particular factor. And then when you look at what dollar yen is doing on the charts, and this is a daily chart, and you can see here that it's had a beautiful rally off the lows. And I remember putting out a note saying that maybe this is just the sign of a turning point, this hammer. And it actually came out really, really nicely, that potential trade. And you can see since it's had some setbacks around about the 50-day moving average, this uptrend was broken, retested, then eventually went back through, and then now is being respected again. And you can see here the price is just kind of coiling up. And this zone here, 149.75 is where I've got it at, up to 151.95, which was the former record highs. That zone looms as really, really tough for me to go and see dollar yen breaking through without a big further hawkish recalibration in rate cut pricing. And given what we're looking at the data this week, to me, I just don't see that playing out. So this uptrend, I'm paying really close attention to what happens, the price signal along here. Can the price go and continue to grind high into this zone, or will we see a downside break? And that's where I'm starting to go and think potentially we might go and see it. Right now, the technical signals are telling me buy dip scuddy, because I can see here, looking at RSI 14 remains in a firm uptrend and not even close to testing at this point in time. MACD as well is continuing to go and trend high, so it looks good as well. But this comes across as a bit like almost a ceiling, this zone here. And you can see the price, the gains have really started to go and slow down, and it's now calling in here. And if we do see a break, who's to say that we wouldn't go and see a move back to 147.20, where you can see the price went and double topped back in September, and then retested it before eventually breaking through, and then came back and had a look and then bounced again. So 147.20 would be on the downside. Beneath that would be the 50-day moving average. To go and break through this zone here and get above 151.95, it's going to take something pretty special. It would probably take initial jobless claims to go and move back to kind of the levels that we saw a couple of weeks ago, very, very low by historical standards, and a blowout retail sales report that would really go and force markets to go and rethink the number of rate cuts that are required from the Fed over the next 15 months or so. As I said, I just don't see that happening, particularly when you look at the likes of the 200-day moving average as well being located in between. If it was to be broken to the top side, 151.95, then you start looking back here. So 155.37, you can see the price tested that on a couple of occasions, both as support and resistance. That will be the first level that I'll be looking at. So to me, whilst the technical picture still looks pretty good for dollar yen, the fundamental picture and looking ahead from a strategy perspective, to me, it's starting to go and look like maybe we're seeing downside risk materialize. Best of luck trading out there this week. I'll catch you next time.